$1.5 trillion was lost from the market today. Not true.
Right.
It was transferred.
Right.
That money didn't evaporate. It went into someone else's hand.
Right.
Yep.
But people just go, oh, the market's down, and they just accept that as the truth. The stock market's irrelevant now. I think it was a brilliant idea initially. It's in the interest of building the stock market was big ideas require capital. And so they went public to raise that capital. No big company raises public capital. It's all private capital.
At all.
100%. The only reason they go public is for one thing, to take money off the table.
Yeah.
So it's absolutely a problem because you have underwriters that have the interest of saying that it's going to be a valuable stock, setting the price based upon their own gains. If they don't, like you watch.
Let's back out of that and simplify that a little bit. Because like if you're in that space or you're thinking about that, you know right away. But one of the things that frustrates me about business or has throughout my journey is it's hard to jump into conversations like this and hear those things and follow them if you don't have any of the context to the path. And like the person that's starting a company or at $1 million or 2 or 3 or whatever, and they're figuring it out, you missed 18 steps to get to actually that conversation. And the historical relevance of that is that 100 years ago, when people wanted to raise money, they did so through the public, and they did an IPO so that the public could invest in the company and they could grow. And today, in the last 50 years, specifically through Silicon Valley, I think, and you could add context to this, but venture capitalists, PE firms, et cetera, will dump money in to private companies that never hit an IPO. And so all of this money, like hundreds of millions or billions of dollars, get invested into private companies for ideas that aren't even making money yet. And then
Media hype.
Yeah, media hype. And then they build. And then the thought is eventually you can go public. But the purpose of going public today isn't to raise money. It's that the founders that got involved in the first place can cash out. They can take the money. Basically, they can sell their shares, the available shares, to the public and pull that money back and say, hey, I made some money.
And let's make it worse. Well, there's only a fiduciary responsibility to the shareholder, not to employees and not to customers, creating a conflict of interest of how the company runs.
Well, let's take it a little bit further, because 25 years ago, there were 10,000 listed companies here in the U.S. Now we're at 4,000 because it's hard to stay listed. So now you're at, you know, so you have 4,000, right at 4,000 companies listed. When you have literally hundreds of millions of companies worldwide. So you can either go the public side of things, which is less than 0.1% of the total companies out there that are investable companies, or you can actually learn, create some expertise, find some people that have expertise if you don't have it, and invest on the private side where options are plentiful.
But you have to learn.
And
one of the challenges is if you want to get into the private markets, and said another way, if you want to invest in companies that haven't gone public, you need to do it through some other vehicle. And usually that vehicle is some fund that is raising money, and they are taking money to raise it. And so, Garrett, one of the things that you've talked about quite a bit is the problems with people that are selling mutual funds and all of the shit fees that go into mutual funds or stocks, et cetera, for somebody else to trade for you. They're the ones making money, not you. And the same thing can be true in the private market, because these funds take 2 and 20, and their incentive is to keep investing in new things, and they're taking that money they're 2% off the top all the time, no matter what.
And if you want to remove value to a customer, venture capital is probably the quickest way to do it.
Remove value from the customer.
Remove value from the customer, because it's all about valuation of the company, which often is make a shit of your product, water it down, move fast, and then exit it. But the other issue, there's so many issues that happen here. So this 4,000 issue that you're talking about, if you're a small company that goes public, you run such a major risk of getting shorted to death.
Yeah.
So what happens is, you create artificial fear and pessimism around a small company, and you keep buying options that basically are put options saying when that company lowers value, you get that. The money goes to you. Because this is the entire crappy illusion that's not real. Hey, $1.5 trillion was lost from the market today. Not true.
Right.
It was transferred.
Right.
That money didn't evaporate. It went into someone else's hand.
Right.
Yep.
But people just go, oh, the market's down, and they just accept that as the truth.
Right.
And so I have a really close friend. They sold their business to a public company, small public company. They got shorted to death. So when they sold, the stock was worth like $3.50. It's now worth like 3 cents.
Oh, Jesus.
So this company they built, and they should have had $20 million they took off the table. they made $1 million on the whole transaction.
That's painful.
Because of that company being public. So you have, like with mergers and acquisition, like think about it, the sharks, all of those statements are true and real. And so that's part of the reason you see 10,000 down to 4,000. Obviously it's arduous and there's all these other rules, but the small companies are just bait.
So let's go tactical on this. So Justin, you spend basically now you spend a shitload of money so that other people on your team audit deals and figure out what's good and what's not.
Yeah.
How do you find the private vehicles that you can invest in to get into the private companies that are exciting in those spaces?
Well, it's all relationship based. You got to find the right people. You got to build a relationship.
You have a reach and reputation.
Yep. They have to want you in it because they don't need your money. Right? They can find the money. So
you're bringing them ease, you're bringing them a community, you're bringing them, there's advantages, right?
That's right. So they're looking for smart money and they're looking for relationships and they're looking for people that can actually add, benefit beyond just the dollars. But this gets into the question of top quartile, bottom quartile. So, if we're talking about, the public side, let's look at mutual funds and ETFs here. Your top quartile is at 9.5%. Your bottom quartile is at 7.5%. So you got about a 2% delta there.
84% of the return in the market goes to 10% of the investors.
What the fuck are you talking about? Can you break that down a little further?
So your best performing mutual funds are going to perform, really about 9.5%. And then your worst performing ones are going to perform at about a 7.5%. So you got about a 2% delta there in that between good and bad managers.
For mutual funds.
Got it. So if you go over on the private side, let's just take private equity, which is going to be, later stage. Your bottom quartile is 4.3%. Your top quartile is 25%. So you're literally at a 20% plus delta.
It's a more inefficient market.
So said another way, mutual funds, it doesn't really matter. You're going to get a decent return. You're going to get a more stable return.
If I put money in mutual funds, which I don't, I just go index fund.
Index fund. If you're going to do it, index fund.
You're better off index than mutual.
Because they outperform money
mutual
managers.
fund with a fiduciary might be 2%.
Right.
Index fund might be 3 basis points.
Right.
If you look at that over 10-year period of time, it's a difference of getting $1 million and 200,000 return. That's the difference. People think, it's only a few percent. No, it's compounded in the cost. It's algorithmic.
So mutual funds, the delta is only 2% between the good and the bad ones, the good and bad performing mutual funds. All you need to pay attention to in mutual funds are fees, basically, because even if they're performing poorly, if they're taking 2% or they're taking, 50 basis points, 0.5%, huge difference. Private money, if you're looking at investing in a venture capital firm or a private office or a PE company, they could return 4% or they could return 25%.
Yeah.
So there it makes a lot more sense to figure out
tens of millions of dollars or hundreds of thousands of dollars.
Yeah.
That's the variance.
It's all about having the relationships, knowing the right people. And by the way, it's even more extreme on the venture side. So the earlier stage you go, the bigger the gap, right? So I think, bottom quartile on venture, I think is negative 7% return. And top quartile, I think, is 27 or 28%. So it's the biggest.
Because they intentionally kill companies in venture. So this company's not performing as much. You're done. We're going with our pony over here that's crushing. So they might go, we're making 10 investments. We think that 1 is going to be a superstar. We think 2 will be okay. And we don't care what happens to the other 7.
Yeah. Because that's the business model.
That's the business model.
And it's not even 1 in 10. It's,
it's like
1 in
credit
100.
card. Yeah. It's like when credit cards first came out, they were pretty low interest. And someone at Harvard was like, you know what? If we just start charging 20 or 30%, the default rate exponentially goes up, but we still make more money. And that's similar to venture.
Yeah. So the question then, because the notion of it's all about relationships is super frustrating for somebody that's new and getting started and doesn't have a network, doesn't have the opportunity, can't spend, a lot of money to be a part of Lifestyle Investor every year. So are there any other ways that you can find those good opportunities or audit or assess those and figure out, hey, is this a reasonable private investment to get into?
Well, I think that, first off, I think getting that investor IQ down and building a foundation, actually understanding what you're doing matters, before you ever put any money in anything. And we have so many free resources on that at Lifestyle Investor, the lifestyleinvestor.com/roadmap, all kinds of things that can help people out in that. We're building a due diligence AI that's going to be able to spit out. I mean, we're we're already in the beginning stages and it's doing well, but we want to continue to iterate on it. So I do think that the AI is going to help in that, but it's AI is still so far away from being able to say, this is a good deal, this is a bad deal, here's the real risk, here's not. So you can't get that, but you can program these AIs to diligence in a way that you want them to be diligenced in. So I think that exists. But I also think that, so the shortcut often is money, right? It's like, how do I spend money to get access? How do I spend money for peer group or for a mastermind or for a mentor or whatever? And some people have to be willing to bite the bullet to do that if they're in a position to do it. And if not, well, then you're relying even more, I think, on your relationship skills, that you're offering enough value to someone else that they see value in bringing you into things.